Hello, everyone, and welcome back. Last time, we delved into the crucial world of fraud and internal controls, uncovering how robust systems can protect a company's assets and ensure the integrity of its financial reporting. Building on that foundation, this time we're shifting our focus to a very specific and vital asset: receivables. In this chapter, Reporting and Analyzing Receivables, we'll explore what these financial claims are, how companies manage them, and why they're so important for a business's health. Think of it as understanding who owes a company money and how diligently that money is being collected. So, what exactly are receivables? Simply put, they are amounts due from individuals and companies. These are claims that a company expects to collect in cash, making them one of a company's most liquid assets after cash itself. When we talk about receivables, we primarily focus on two main types: accounts receivable and notes receivable. If these result directly from sales transactions, they're often called trade receivables. We'll begin by understanding how companies recognize these receivables. For a service organization, it's typically when a service is performed on account. For a merchandiser, it's at the point of sale of merchandise on account. It's also important to consider factors that can reduce receivables, such as sales discounts offered to encourage early payment, or sales returns and allowances if goods are returned by a buyer. A major part of managing receivables involves addressing the inevitable challenge of credit losses. When a company sells on credit, there's always the possibility that some amounts won't be collected. These uncollectible amounts are recorded as bad debt expense, also known as uncollectible accounts expense. This is a normal and necessary risk of doing business on a credit basis. We'll examine two primary methods for accounting for these uncollectible accounts. The direct write-off method records losses only when a specific account is deemed uncollectible. However, this method is generally not acceptable for financial reporting under GAAP because it doesn't match the bad debt expense to sales revenue in the same period, nor does it present accounts receivable at their true expected value. This leads us to the allowance method, which is required by GAAP. This method involves estimating uncollectible accounts at the end of each period. It provides a better matching of expenses with revenues on the income statement and ensures that receivables are reported on the balance sheet at their cash net realizable value. That is, the net amount the company actually expects to receive in cash. We'll discuss how companies estimate this allowance, often using a percentage of receivables basis, which can involve an aging schedule that categorizes receivables by how long they've been outstanding. We'll also touch upon the expected credit loss model, a sophisticated approach required by the Financial Accounting Standards Board that uses data analytics for timely and accurate estimates. This is where our previous discussion on internal controls comes into play. You might recall our fraud case from the last chapter involving an accounts receivable clerk. That story highlights why strong segregation of duties and independent internal verification are absolutely critical when dealing with cash and receivables to prevent fraud like the cookie jar allowances we've also seen in practice. Beyond just valuing them, companies also need strategies for disposing of accounts receivable. Sometimes selling receivables is the only reasonable source of cash for a company, or it might just be easier for a company to outsource the billing and collection process to a specialized third party. We'll look at two common ways this happens. First is factoring, where a company sells its accounts receivable to a finance company or bank for a fee. This provides immediate cash, though at a cost. The second is national credit card sales, which are generally considered cash sales by the retailer, even though the retailer pays a service fee to the card issuer. This allows retailers to avoid credit risk and collection efforts. We'll also introduce notes receivable, which are more formal credit instruments than accounts receivable. They represent a written promise to pay a specified amount of money, giving the holder a stronger legal claim, and they can be readily sold to another party. We'll cover how to determine their maturity date and calculate interest on them, and what happens when a note is either honored, meaning the maker pays it in full at maturity, or dishonored, which means the maker defaults on payment. Finally, we'll cover the financial statement presentation of receivables and delve into the crucial principles of receivables management. This includes establishing sound credit policies, setting appropriate payment periods, and consistently monitoring collections using tools like the aging schedule. To assess how effectively a company is collecting its receivables, we'll learn about key liquidity ratios like accounts receivable turnover and the average collection period. The chapter concludes by showing how data analytics is increasingly used to improve credit decisions, estimate uncollectible accounts, and optimize the entire receivables management process. This chapter is all about understanding the delicate balance between extending credit to boost sales and efficiently collecting those debts to maintain a healthy cash flow. It's a critical aspect of financial management. As we wrap up our discussion on current assets like receivables, we'll be ready to transition to our next big topic: reporting and analyzing long lived assets. These are the assets that a company expects to use for many years to generate revenue, and they have their own unique set of accounting challenges and analytical considerations.